Time once again to check on the latest earnings trends with Zacks Director of Equity Research, Dirk Van Dyke. Well, here we are in the kickoff to first quarter earnings season. I guess it might be an understatement to say that negative news has been factored in.
It appears that way. I mean, while we're off a little bit today, the market has certainly been rallying in the face of news that is either just plain awful or everybody expected it to be awful, and you know, it came in as in line with people's awful expectations.
Yeah, so maybe it's an overstatement. I don't know, but the new mark-to-market rules here have taken effect already. Do you think they're going to be bringing any upward revisions to the earnings of the market as a whole?
I'm not sure about the market as a whole, but we've seen some rather dramatic increases in the first quarter expectations for the mega banks, which has dragged up the entire financial sector and the S&P, as a matter of fact. Right now, the financial sector is only expected to be down 9% in terms of total net income in the first quarter relative to a year ago. A week ago, that was over 30%, and that's dragged the expected decline for the entire S&P from minus 37 to about minus 27.5. It's a dramatic move concentrated in just the big mega banks, the Citigroup, JP Morgan's, names like that.
You think that's brought about by the new rules?
Yeah, I think two factors. The new rules, which pretty much don't change the economic earnings, but certainly do change the accounting earnings, and the analysts do try and hit the accounting earnings. Mm-hmm. I don't think it does anything whatsoever for the underlying economics of the business. The other is probably some of the AIG flow-through. I mean, we dumped all this money into AIG, and then AIG promptly was turning around and writing checks, mostly to big banks, both foreign and domestic. Some of that's going to flow through. It's also, you know, a positive yield curve, so they've got nice net interest margins. You know, in January and February, the CEOs were saying that on a pre-provision basis, sort of a straight operating basis, that they were profitable. So, I mean, some of those things also factored in, but it was a rather dramatic move.
So then, are the worries over the Q1 earnings for the bank sector founded or not founded?
Well, again, it's the accounting earnings are going to probably come in a lot better than people feared. But again, it's, you know, analysts and investors, particularly. I mean, analysts try and match what the company is going to report. Yep. But investors really have to be interested in what the underlying economic earnings are, and you still have massive amounts of bad loans on those books.
Let's talk about that. Everybody seems to be focused on balance sheets, and they're not focusing on current loans. Shouldn't we spend more time looking on loan losses for what's already on the books?
Well, yeah. I mean, what's on the books is where the balance sheet's going to come into play, where you have to add to the provisions for those legacy or toxic assets, but less so now that the banks can simply make up whatever they want it to be worth.
All right, let's get away from the banks for a little bit. Let's talk about companies in general. They're going to miss expectations by a wide margin, narrow margin, or are they not going to miss expectations?
Well, I mean, historically, we always have more positive surprises than the negative surprises. Even last quarter, which was an absolute disaster in terms of earnings, you still had almost twice as many firms reporting positive earnings surprises as disappointments. Now, the disappointments were bigger and more massive and in bigger companies, so overall the total net income came in a lot worse than people expected. But in just a raw count, you had more positive surprises than negatives. That will probably continue again.
What do you think about Q1 then? Better than last quarter?
Oh, better than last quarter, but still ugly. I mean, last quarter was just absolutely horrific. You know, let's pray that we don't have another $61 billion loss at AIG. No, some of that was extraordinary, and we're carrying $35 billion loss for the quarter, which was the operating loss. But I don't think we're going to have that sort of loss again in the first quarter, which will make the overall quarter somewhat stronger.
Give us the bottom line on Q1. What are you looking for?
I think we're probably going to be down about 30% in rough terms year over year in terms of total net income.
All right, let's see how it shakes out. I know you'll be keeping an eye on us as the weeks go by to fill in all the blanks. If you want to fill in the blanks on some of the other numbers that Dirk has posted in his most recent earnings trends, get over to Zacks.com. They're all there for you, nice, neatly organized in tables and everything, and a lot of other commentary surrounding it that we just don't have time for here. Look down the homepage till you get to Dirk's picture. The headline right next to it will take you right to the current earnings trends with Dirk Van Dyke. I'm Terry Ruffalo.